In this video we are going to study an advanced technical analysis of the US dollar versus the Swiss franc in the 1-hour timeframe. This analysis will be mostly performed using the fractal flow strategy with a few elements of the market maker strategy as well. Let's begin the analysis with two important guidelines, which are the amount of data available for analysis and the recognition of major and minor flows. I have about 140 candles available in the chart. This seems rather simplistic, but selecting the amount of data that you are going to use to analyze the market is critical because of the problem of dynamic resolution. We have to choose enough price action so we can have a good idea about the overall context at the same time that we can also see the details and nuances of price. In other words, if you zoom in too much, you will only be able to see details without the proper context, and if you zoom out too much, you will only be able to see the overall picture without the depth provided by the small details in price. This simple solution to this dynamic resolution problem is to use somewhere about 200 candles in your analysis. This is not a fixed rule, of course. You will have to develop a certain feel regarding this. As you can see, even something apparently simplistic as choosing the correct amount of data in a chart has some deep problems behind it. By observing the chart, the first thing that comes to mind is the market vector between number 1 and number 2. This is not an ordinary vector if you look at it for a while. Observe how almost every candle in that vector forms a lower high and lower low, not to mention that every single candle in there has a bearish quality. Regardless of the intervention of market makers or not, this can be classified as an exhaustion vector. This is analogous to a final leg in a trend where one of the market players gives all its power to finish off the movement. You will often find that market vectors like these usually terminate a flow and begin a brand new one right after. This is one of the clues we look for when we suspect a flow shift in the market. Notice also that high number 1 is a very clear structure, maybe to the point where it is too obvious. From number 2 is where I believe the new flow regulated by buyers began. We have to pay attention to what happens around high number 1 when buyers reach that level, but that will come later in the analysis. Notice that the alleged new flow upwards begins with a massive fractal candle pointing up. It's also interesting that the vector between number 1 and number 2 also started with a fractal candle, so we have fractal candles in both extremes of the vector. From number 2 to number 4 we have a few interesting details to look at. Observe that in the vector between number 2 and number 3 there is a small bump in the middle that could be classified as a vector in the minor flow. I drew a horizontal line in the low of that small bump to show how retail traders might get caught in a manipulation maneuver in the movement from number 3 to number 4. Observe how low number 4 seems to trigger the sell stop orders that were placed in the low of the small bump, and also how price immediately starts to rise after that poke. As usual, there is another fractal candle in there that kicks off the movement from number 4 to number 5. I would like you to give your opinion on rather what happened in low number 4 was a manipulation or not. Tell me what you think by leaving a comment below. In the movement from number 4 to number 5 we have a similar situation with the creation of a minor flow vector in the middle of the major vector. Beyond that we also have the minor vector finishing off with a small gap created in the last candle down. To add another level of complexity to this movement between number 4 and number 5, we can see that it violates the high number 1 that started the exhaustion movement of the sellers. Observe that price doesn't seem to have any major reaction to that high number 1, which is something that gives more weight to the theory that a brand new flow started in low number 2. Notice that I drew a horizontal line using minor low inside the vector from number 4 to number 5. Take a moment to appreciate how the shape of these two major vectors pointing up is analogous. This is almost a perfect representation of one of the fundamental axioms of technical analysis, which is that the past tends to repeat itself in the future. Right after high number 5 we see that price goes down and lands exactly in the horizontal line drawn in the bump before the rise. In number 6 we have an interesting situation momentum-wise, and this is where the long trade idea began to solidify. Notice that between number 4 and number 6 we have a hidden divergence, and number 6 is another fractal candle. This gives us a hybrid fractal divergence. In fact, observe that we have fractal candles pointing up in all major lows in the chart. That should give you some idea about the power of this concept. Take a look also at the shape of the candle number 6. The best interpretation of that candle is that sellers were once in the lower part of the candle, but buyers annihilated the sellers to create a bullish candle with a dead lower tail. If you think about the situation in number 6, you will see that it is analogous to the probable manipulation in number 4. It's exactly the same scenario, but if you don't increase your abstraction level, this sort of detail would pass unnoticed. The trade you see in this chart was triggered at the open of the candle right next to candle number 6 as it is indicated by the green arrow. The stop loss was placed a few pips below the low of fractal candle number 6 due to the incredible convergence of different techniques to that point. The target for the trade will be dynamic, and it will follow an extrapolation of the sloped frequency line that I drew from low number 4 to the frequency along the tails of low number 6. Notice how I extrapolated the same angle to the line that spirals from high number 5. This is the line that the target order will follow dynamically. That seems like a good risk-reward potential, so let's see how this trade develops. Observe that the target was hit at the extrapolated sloped frequency line. Observe also how price touched the original frequency line before it shot upwards to the target. I hope you learned something new with this analysis. If you like this type of video, don't forget to subscribe to the channel, click the like button, and leave your comment below. If you wish to learn how to use these techniques to produce trades like these, check out the strategy store in the link available in the video description or send me an email with your questions. Thank you very much for watching and I hope to see you in the next videos.